Hey everyone, this is Randy from Income Stacker, and today we're going to talk about how to determine in 5 minutes or less whether to rent or own or finance a property. Get this question a lot. Someone gets a property, whether they buy it through the MLS or for sale by owner or get it through a note acquisition, and they have a property sitting there and they say, should I rent it or own or finance it or sell it? Well, today we're going to talk about renting it versus owner financing the property, and just looking at a very simple way to do the math and to determine which direction to go. All right, so let's take a look. So what do you first need? So just like anything you do, let's say you buy a new gas grill and you got to put the darn thing together, and it says, okay, you need these tools. You need a screwdriver, and you need a wrench, and you need pliers. Well, these are the 5 things you need before you start. So let's start at the basis. Basis is simply the property price plus cost to acquire. Or if you bought a note, it's the note acquisition price plus any legal cost. Repairs, okay, those are the minimum repairs needed to make the property livable. A viable property is what I call it. And I'm not looking to make Taj Mahal properties when I'm selling or renting the property or selling with owner finance. I'm making it nice, clean, and livable. If they want to make it the next level, that's perfectly fine with me. ARV, after repaired value. What's the value of the property after the repairs are done? Once I get the repairs completed, what is the after repaired value? The next is the rents. What's the rent for the property? What's the current market rent for a similar property in a similar area? And finally, tax and insurance. What's the current tax and insurance if on this property? You can, again, look these things up. Most of these you can look up. Tax insurance, you can look up. Rents, you can look up. After repaired value, you might have to do some math on that or get somebody to help you out there in terms of an appraisal, but usually I'll just do research. And repairs, again, that's something that you get better at over time. In the meantime, get a good experienced contractor with you. And finally, the basis is simply doing a little math. So once you have this information, you're going to take that information and basically do a little math. And we're going to look at a property. As an example, we're going to look at a property that we got in Oklahoma a while back. And it's a low value property. But the good thing about it, it will cash flow both on a rental and owner finance basis. So we decided to take a look at this particular one. A lot of properties that you buy nowadays are hard to cash flow as a rental. So I thought I'd use this as an example since the value was pretty low. Okay, what's the information? These are the 5 things we need. Basis. Well, the basis is $70,700, which is essentially we purchased this on a note for $66,000, and we had some legal expenses of $4,700. So the total was $70,700. Repairs estimated at $22,000. After repair valued $130,000. The rents in the area are roughly $1,300 a month, and the tax and insurance are $180 a month. So now that we have all this information, we're just going to plug it in, right? So we're going to do some simple math. First, we'll talk about the quick math on doing rental, how to figure out, what's your return going to be as a rental. Now, again, this is a very kind of a low level, just to try to figure out if it's thumbs up or thumbs down type of thing. But what I typically do is just take the rent, which is $1,300, and subtract out the expenses, right? You got tax insurance, that's one expense, that's $180. You got another expense, which is maintenance and vacancy. So I just said, okay, let's just say 10% for those two. And then you multiply it by 12 because there's 12 months in a year. Now, there's other expenses, possibly if you had property management. But again, in this example, we're not going to look at that. Then you divide that by the basis plus the repairs. So roughly the basis plus the repairs is $92,700. So you're subtracting this by this to get roughly 12.8%. So really good return for a rental in today's environment. Owner financing, quick math. Again, if we sell the property at $130,000, remember we said the ARV is $130,000, we get a down payment of $13,000. That leaves a balance of $117,000 that the buyer owes us. at a rate of 8.95% in a term of 20 years, we get a payment of $1,049. Why do we use 8.95? That's just the number. We're roughly around 9%. We see that's pretty easy to get. And we use a term of 20 years, sometimes 15, sometimes 10. The lower the term, typically the better, but sometimes the payment's too high if we go too low of term. So in this example, it's a 20-year term. And now what do? Again, we plug this into a calculator and figure out what? Well, we're going to figure out how we got the PI payment. How did you get that PI payment, Randy? Well, this is what we did. It's very simple. Typically, there's tons of calculators online. But I suggest, if you're going to be in this business, to buy the 10BII, which is, it's an app you can download. It's $10-15, and it's really a good calculator for this stuff. So what do? Well, you got 4 numbers you have to plug in. N is the number of months. I is the interest rate. PV is the unpaid principal balance, or also stands for present value. And then PMT stands for payment. And then final value is typically 0 because it's totally amortized. So what's the PV? Well, that's the unpaid principal balance. Present value is $117,000. Now, why is it negative? When money goes out, it's negative. So money's going out here, $117,000. That's just the way it works. And the interest rate is 8.95%. We plug that in. N is 240 months or 20 years. And then we solve for payment, PMT. Very simple, easy peasy. And we don't have to worry about tax and insurance. Why? When we sell with owner financing, who pays tax insurance? Do I? No. Does the buyer? Yes. So I don't have to worry about it in my math. Okay. So now, once we have all this stuff here, again, this is what they owe us, but this is not how much, everybody's like, well, you're getting 8.95%. No, we're getting more than 8.95% because we didn't pay $117,000 for this property, right? We didn't put that much cash. We put less cash than that into this property. Well, how much did we put in? And so we have to figure that up and stick that value in there and recalculate the interest, right? So let's take a look. All in, we have the $70,700 basis, right? That's what we purchased it for. We had $22,000 in repairs, and we got $13,000, so we have to subtract that. So we're all in right now at $79,700. I plug that into PV as a negative number, and then I solve for I, interest, and it comes out to 15%. If I click that, it comes out to 15%. Boom. So if we look at owner financing, we're going to be making 15% versus the rental was 12.8. Both are pretty good. Obviously, the owner financing is a little better, and it's always going to be better, typically. So the question is this something you can do? Now, in a future video, I'll actually plug in the numbers into a calculator so you can see how it's done. But again, it's pretty simple. If you do this enough, you get very quick at it. You just have to do it enough times to feel comfortable with it. So let's summarize. Summary is here. What's the return with owner financing? 15%. Rental, 12.8, so it's a little better with the owner financing. Risk level, it's a lot lower risk with owner financing. Why? You don't own the property. There's no slips and falls, right? Whereas a rental, it's high, right? Somebody could sue you. Passivity, how passive? Owner financing, it's very passive. Rental, I would say medium. I wouldn't say high because, if you have a good rental and you know how to manage it properly, it's usually medium. But you still have to do what? Well, they call you about the toilet, they have to go fix it. Whereas the owner financing, no one's calling you at night, right? Because they own the house, so they're paying taxes, they're paying insurance, they're fixing the property, they're doing the maintenance. So hopefully this helps give you a quick way to determine, give you some idea which direction would be better. And, if you have any questions, put your comments below, and we'll see you on the next video.